Hi guys, it's Stock Curry, and in today's video I'm going to tell you what very important economic news is coming out on Friday that you need to watch, and we have to discuss some more news that points to a global recession. So let's get into it! Let's start with the news that just came out that points to a global recession. Now, why is this so important? Well, we already know that the United States is on the brink of a recession. We're not there yet, and we may or may not be in a recession currently, but for sure, we're definitely headed in that direction. Now, the reason it's so important to look at the global economy, especially Europe, in order to determine just how bad a recession in the United States might be, is because when the United States experiences a localized recession, meaning only the United States is in a recession, the recessions tend to be very mild, and we generally can get out of them very quickly. Think about what happened in 2018, 2019. That recession was in the United States. It was very mild. It was limited to the United States, and we got out of it fairly quickly. In fact, if you ask most people when the last recession was, they're probably going to tell you 2008, because most people didn't even feel the effects of the 2018 and 2019 recession. It just wasn't big enough to actually affect most people. So when a recession is localized to the United States and it's not spread throughout the entire world, the recession is very mild and it doesn't really affect a lot of people. However, when a recession is global, meaning not only is the United States in a recession, but other markets are in a recession as well, especially countries in Asia and Europe, those recessions tend to be far more severe, far more long-lasting, and far more devastating to the stock market. Think about the period from the late 1970s to the early 1980s, when we had 3 recessions in a 10-year period and the stock market fell by 80%. Think about the period from 2000 to 2002, when we had a global recession and the stock market fell by 80%, at least the NASDAQ did. Think about 1987, when we had a global recession and the stock market fell 60%. Think about 2008, when we had a global recession and the stock market fell by 60%. You get the idea. During global recessions, the stock market falls significantly more than it does during a localized recession, and the economy is in a far worse situation than it is during a very minor localized recession. So today, some business surveys were completed, and it's not looking good for Europe. What we're going to do is go through the actual numbers and show you exactly what the business survey had to say so that you can get prepared for what is about to happen. Generally speaking, the business survey pointed to the US and European economies slowing sharply, with recession risks growing substantially. The US and European economies slowed sharply in June as surging prices of energy and food weakened demand for other goods and services. Europe faces additional pressure from a possible energy shortage this winter. Now take a look at this chart. This is the Composite Purchasing Managers Index. And what it shows is how much businesses are buying in inventory in order to prepare for future sales. And as you can see on the chart, businesses are buying less and less inventory to prepare for future sales, meaning they're expecting future sales to decline. And of course, this is happening not only in the United States, but also throughout Europe. S&P Global said on Thursday that its U.S. Composite Purchasing Managers Index, that's that chart you just saw, which measures activity in both the manufacturing and services sectors, fell to 51.2 in June. And in the eurozone, the index fell to 51.9 in June. Now, a reading above 50 points to an expansion in activity, while a figure below 50 points to a contraction in the economy. And of course, we are dropping fast and getting very close to that 50-point threshold. The results point to a U.S. economy that will grow at an annualized rate of less than 1% in June and contract in the third quarter. In other words, recession. In Europe, survey readings point to a second quarter growth rate of 0.2%. Manufacturing output in both the US and Europe declined for the first time in 2 years, while a services sector that had been boosted over recent months by the lifting of COVID-19 restrictions cooled sharply. Now, the reason this is so important is because a lot of people have been pointing to the services sector as essentially holding up the economy. People have been saying that yes, consumers are spending less and less on goods, but they're spending more and more on services. However, the business survey points to that not being the case any longer. The business survey points to the services sector declining and contracting, which is going to be very, very bad for GDP and the economy, and will very quickly get both the United States and Europe into a recession. In Europe, June's slowdown was the sharpest recorded since November 2008, at the peak of the global financial crisis. That's right, Europe's business sector is already declining at the same rate it did at the peak of the global financial crisis, the Great Recession. The worst of the worst points, Europe's business economy is currently at that point right now, and it continues to decline, setting Europe up for a worse recession than they went through in 2008. And elements of the survey pointed to even tougher times ahead. For the eurozone, economists now see the economy in recession in the final quarter of this year and the first quarter of next year. This is bad. This is as bad as it gets. We are literally talking about Europe not only entering a recession, we are talking about Europe entering a recession that will be worse than the Great Recession of 2008. And folks, if you think that this is not going to affect the US economy, you are sadly mistaken. Because US GDP is based largely on the amount of goods we can export to other countries. And if the world is in a recession, they are going to be buying less, they are going to be importing less US goods, which means the United States is going to be exporting less and less US goods, which means the US economy is also going to be in a worse recession than we had in 2008. Now, of course, a lot of this is driven by high inflation. And the Fed has made it very clear that they are committed to doing absolutely anything and everything necessary to get inflation down, even if it means putting the economy into a recession. Now, here's the problem. Not only is the Fed going to be raising interest rates in order to put us into a recession for the strict purpose of lowering inflation, but Jerome Powell has already said that monetary policy alone, that is, the tools in the Fed's toolbox, essentially the ability to raise interest rates, is not enough to bring inflation down. In order for inflation to come down, there are some global impacts that nobody really has control of, at least here in the United States. Those are things like the Ukraine war and OPEC that we just don't have control over. But more importantly, fiscal policy will also have to be enacted, meaning Congress and the president will have to work together to enact fiscal policy or changes in order to boost the economy. Now, the biggest issue right now is a drop in supply while demand remains high. Now, the Fed, through monetary policy, can lower demand. What they are not able to do is they cannot increase supply. However, there are certain things that Congress and the president can do working together to increase supply, and this is done through fiscal policy. For example, we have a chip shortage here in the United States. Now, one of the things that Congress is doing in order to increase the supply of semiconductor chips is they are working on a bill that is going to provide significant funding to help companies like Intel and AMD build factories here in the United States in order to build more semiconductor chips in the United States, therefore helping to resolve some of the supply chain issues that we continue to face. So with the significantly high inflation and Jerome Powell telling Congress straight up, you need to work on fiscal policy right now, you would think that Congress would be taking this as a high priority item, right? Well, not so much. Intel warns that their Ohio semiconductor factory could be delayed because Congress is dragging its feet on funding. Specifically, this has to do with something called the CHIPS Act, which is supposed to provide funding for construction of semiconductor facilities. Unfortunately, Congress has drug its feet on passing this in order to work on bills that they feel are more important. And this is not helping the economy at all. Until Congress starts to pass fiscal policy to help fix the supply chain issues, inflation will not come down. Now, let's get on to the very important economic news that's coming out on Friday. So far, we have seen a lot of indication that businesses are slowing down, and that just on the business side, we may be entering a recession here in the United States. What we have not really seen in the numbers yet is a slowdown in the housing market. Yes, we have seen demand slow down a little bit, but supply was still so high, it really hasn't affected things yet, and of course, housing prices continue to go up, at least through April, when the mortgages that closed in May were actually signed and contracts were settled upon. On Friday, though, we are going to get our first indication of a possible true slowdown in the housing market. And we already got some numbers coming out on new construction. We are seeing new construction builds starting to slow down. That's okay. We kind of expected that. But the real question is, are the new homes that have been built, are they actually selling? Because remember, one of the big issues that we had, one of the big questions we had was all of the construction that got built. A lot of that, if it was a custom built home, was agreed upon a year ago or more, and they would now have to close. But with mortgage rates at double where they were a year ago, essentially people's mortgages, the amount of money they pay per month, could be double what it was a year ago. And it's very possible that somebody who went on contract on a construction loan a year ago can no longer afford to actually buy that house. In addition to that, there are a lot of home builders that will build houses in bulk. Before they're actually sold, they build these houses in bulk, and then once they're finished, they go to sell them. The question, the data we just haven't gotten yet is, are all of these new construction builds actually selling? That's what we don't know. But that is what we are about to find out on Friday. On Friday, new residential sales numbers for May will be released at 10 a.m. That's 30 minutes after the market opens. New home sales, also known as new residential sales, is an economic indicator that measures sales of newly built homes. New home sales data is based upon a representative sample of home sales and is driven by factors such as household income, unemployment, and interest rates. In other words, it's an indicator of whether or not we may be entering into a recession. New home sales is actually one of the best leading indicators in the housing market. So this is going to be very, very crucial for us to look at on Friday, because if the new home sales point to a significant decline, meaning not only are new homes that are being built not being sold, but in addition to that, if people who had started construction on a house are now not buying and not closing upon their new construction that is finally finished, this could be a significant indicator for an impending recession and a significant slowdown in the housing market here in the United States. So it's going to be very, very important news that we need to watch out for on Friday, and no doubt it will more than likely have an impact on the stock market. So watch out for that 30 minutes after the market opens. Alright, I hope you enjoyed that video and got a lot out of it. Just remember, recession or not, no matter what happens to the stock market, up, down, or flat, we continue to make money in the VIP Discord. If you want to know everything I'm buying and selling and all the trades I'm making in order to make money in this extremely volatile environment, you can come join us in the VIP Discord. You can sign up at stockcurry.vip/getvip. That's stockcurry.vip/getvip. My portfolio is almost doubled on the air. We're up almost 100%. So come and join us so that you can make money in this extremely volatile environment. There is no reason to continue to lose money as the market goes down. We are making money and you can too. Come join us. I'll teach you how. It's stockcurry.vip/getvip. I'd love to have you and coach you to help you make money in this very volatile environment. Also, I wanted to remind you that if you're looking for a broker to trade options on, Webull continues to offer their 6 free stocks worth up to $12,500 just by signing up using my link in the description below. All you have to do is sign up using my link in the description below and deposit just $1 into your account by the end of this month, and Webull will send you 6 free stocks worth up to $12,600. It is their best promotion ever, and it ends in just a few short days. Alright, I hope you have a lot of success trading. Don't forget to hit the like button and subscribe. And if you're on YouTube, go ahead and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you on Monday.